We're going to talk about silver. This is the silver panel, and my talk is going to be on how the silver squeeze could be coming back into play. We're talking about something called a Minsky moment, I think, that is approaching. So my first part of the talk is going to be sort of macroeconomics. And Minsky was actually an economics professor at a few larger US universities. And he had something called the financial instability hypothesis. And that hypothesis is that financial crises are actually normal and they're to be expected. And someone else actually coined the term the Minsky moment. And really what it is that crashes will follow excessive debt buildup. And I think we're getting close to that again. Global debt is, and this number of 315 trillion is actually at the beginning of 2024. I don't know the current number. I'm sure it's well above that already. And what we've seen is in the last sort of 2 to 3 years, the growth of money supply had slowed, but that it started to take off again in 2024. So in the first 9 months of 2024, it was up $7.3 trillion. So that pace is coming back again. Something interesting and weird is happening in the bond market. For the third time in the last almost 3 years, you've had the 10-year yield break out under similar economic circumstances. We've seen this happen recently again. That hasn't happened with this kind of frequency since the 1970s. We know what happened in the 1970s in terms of inflation. And this really, we think, signals a shift in the behavior of interest rates. And really, if inflation is up and rates go up, meaning bond yields are higher, what that typically does is that it pressures stocks, which makes sense because stocks compete with bonds. And if bonds are paying higher yields, then you have that opportunity cost of not being in bonds. So the last time that we had this kind of action was in August of 2023, and the S&P was down 10%. So this is an interesting chart. It overlays inflation from the 1970s with now. Now the scales are different on the two ends. But the rise and fall, the momentum is very, very similar. And so we're in that circle right now, where in the 1970s, that was, for the 70s, it was after the second wave. But if it follows closely enough, then we could be, I think we're probably a couple of quarters before inflation really starts to turn up again. And all the signs are there. Americans, for example, are now expecting a 3.3% average annual inflation over the next 5 to 10 years. Just a few quarters ago, that was under 3%. They're really starting to believe and feel and accept that inflation is really baked in now, and it's not going away. It's going to be with us for quite some time. Something really strange has also happened. This is something that we've never seen before. Normally, when the Fed starts to cut rates, bond yields will follow, which makes sense if you think about the idea behind it. If they're cutting rates, is because, let's just say technically, the markets need a bit of support, or the economy needs that kind of support by cutting rates to stimulate again after they've been hiking rates. And so lending will need help. So if you've got lower bond yields and lower lending rates, then it matches because the economy needs these lower rates, so people will start borrowing again. What we've had since September is the opposite of that. We've never seen this before. A 100 basis point rate cut has actually triggered a 100 basis point increase in the 10-year yield. So really what it's telling us is the market thinks the Fed is wrong. It's telling us that the market thinks that the Fed did not need to start cutting rates. The economy did not need this juice, so to speak, and that the bond market believes that inflation is coming back. And the bond selling is that signal. It's really telling us that the market expects higher yields to come and to last. So to summarize it, really, the Fed's dilemma is, on the one hand, stop cutting, fight inflation, but as we know, with record debt levels, that's very difficult. The U.S. Budget now sees interest as its highest expense line. a huge demand on a huge burden on the government. It's a burden on Wall Street. It's a burden on Main Street. Or the Fed could instead continue cutting, maybe not immediately, but over time continue to cut over the next perhaps year or year and a half. That, of course, would be convenient for the government with its record debt levels. It's helpful to the economy, and it leaves room to eventually, we'll see eventually how long that takes, but to hike rates again in the future. What it's for sure going to do is lead to more inflation. I think that the second option is the path of least resistance, and I think that's most likely the route that they're going to take. Just sort of one little note as well. We talk about sort of Main Street and the average consumer seeing and believing and accepting that inflation is here now, but shareholders are starting to see this as a problem as well. So here I say Amazon, but apparently it's also Microsoft. They've seen this happen. So here we're talking about Bitcoin. So what happened was a proposal was made by the National Center for Public Policy Research that Bitcoin be considered by Amazon and by Microsoft as a treasury asset. Now, of course, it's volatile, but it does have a hard cap, so it's considered hard money in that sense. And so they see that as inflation protection. And so their argument was this: during inflationary times, corporations have a fiduciary duty to maximize shareholder value, not only by working to increase profits, but also by working to protect those profits from debasement. And well, if you read my book 2 years ago, I said something very similar at the time. I said companies may one day be challenged by their shareholders for holding too much cash as it loses purchasing power, hurting share values. And here we are about 2.5 years later, and we're starting to see that actually play out. So more important, what is the opportunity? So in silver, what we have is, if you add up the different aspects of it, the fundamental, the sentiment, and then the technical aspect of it, you really do see an emerging silver bull market. So we clearly have rising industrial demand. We're at deficits. The industrial demand is at the very least stable. I think it's steadily rising, and it's going to help to provide a rising floor under the silver price. We have investment demand that ebbs and flows, but when it flows, it really comes back strongly. And that's really the wild card that causes these spikes in the silver price. And then you have limited supply. We know that. And that, along with a potential squeeze, I think are the ingredients for another silver rally and silver bull. So if we look at the fundamentals, demand outstrips supply. We know this from the Silver Institute. The last 4 years have seen a silver deficit. They think that these are going to persist for years to come. They're not even giving any kind of a timeline. They're just saying the next several years we're going to continue to see deficits. They're even saying we're going to see record deficits within the next 5 years. So, I'm a little bit on the fence on in terms of the growth in solar. I think it's going to continue. I do think it's going to slow down. It'll continue to grow, just not at the same pace that we've seen in 2021, 22, 23, 24. So I think that's going to continue contributing to demand for silver, just not at quite the same rate of growth as we've seen before. That being said, we have a history of underestimating demand from solar. So this chart tells us that if you go back to 2010, and you look at 5-year forecasts of solar installations, they were actually more than 3 times higher than those 5-year forecasts. So solar really surprised a lot of people in terms of how much solar was going to be installed and how much, obviously, that bled into silver demand. Another aspect is data center power demand. So we know that data centers are consuming a lot of energy. The AI aspect of it now is going to just push it that much higher and that much faster. What we've seen is that the big players, the sort of the Magnificent Seven type of companies, Microsoft, Apple, Meta, they've gone to the nuclear side to get, they have the ability as well. They've got the capital, they've got the contacts. You have a few projects where you've had sort of these I'm going to say dormant nuclear facilities that have not been at full capacity, that they've been able to revive. But that's not for everyone. It takes a lot of, again, it takes a lot of capital, and it takes, there are just so few opportunities like that. I think that, sort of the next tier is going to have to look for other options in terms of power. I think solar is the answer for the most part for them. It's fast, it's easy to permit, let's just say acceptable, on an ESG side of things, at least more acceptable, more readily acceptable. So I think that's going to help feed demand on the solar side as well. Now, big deficits are expected in the silver market, and this goes back to 2020. It's Bank of America Global Research and Incrementum that looked at and did this research, and they said, if you look at all the base metals and you look as well at platinum and silver, how did things look going out 10 years? And by far, the biggest deficits would be in silver, up to the tune of 120%. So I don't know how mathematically that can happen. I can only imagine that, the secondary inventories are going to be long gone. We're going to have to be tapping into private hoards of silver. And you have to ask yourself, at what price is that actually going to take place? Some really interesting research has come out of TD recently, and they've titled it sleepwalking towards a silver squeeze, and that really the market is missing this almost completely. And what they're saying is that if you look at the price of silver futures and the exchange of those futures to physical, the premiums have really gone out of whack, and they're abnormally high, and it implies that the market participants are really choosing to take delivery of physical metal to avoid these potential tariffs that Trump is talking about on future deliveries. So technically what's happening, and if you want to summarize it quickly, is this. The metal is flowing mostly from London to New York on Trump tariff fears, but where London is the 800-pound gorilla, only 30% of London silver is actually available for delivery. Here's kind of how it looks. So this is silver inventories at the LBMA over the last 10 years. You can see that they peaked around, I think it's 2021. I don't have the years at the bottom. That's approximately where it last peaked. And we're down. We're at near 10-year lows. December, the last month we have numbers for, was down 23 million ounces. And here's a little perspective of how the inventories break out in London. 825 million ounces of silver. ETFs represent about 60% of that, 525 million ounces, so that's not available. So that leaves a free float of about 300 million ounces. Daily trading requires about 250 million ounces, so your buffer is only 50 million ounces. That's also near historical lows. So very, very tight market. In New York, they have about 300 million ounces. Only 23% of that is what's considered registered silver, so that's just 70 million ounces. That's what's available if someone wants to take delivery of their silver. So on the COMEX, silver inventories have recently spiked. That speaks to this delivery or these transfers of metal coming from London and going into the New York market. We've seen also people taking their silver out of New York, asking for physical delivery. We have a spike again in the month of December, an outsized spike. In Shanghai, we've seen also this spike in silver inventories. I think that also speaks to metal flowing from London and going to these markets that want to avoid tariffs. And if you look at the premiums, this is not as high as it's been, but it's spiked again just very recently. We're at almost 10% premiums in China over US prices for silver. In India, I'm going to look at the premiums as well in a second, but we've seen a lot of silver flow into India. For different reasons, they're buying silver a lot as well. We've seen silver ETFs, and their average is about $40 million US per month flowing into silver ETFs, and they've only been created back about 3 years ago. And the premiums, as I say, they're a little bit different, but they're 20% in India over US prices for silver. And that apparently is being driven more by rupee debasement. And if you look at the near-term futures contract in New York, back on January 9th. I didn't check what news was happening on that day, but there was a 50% jump in March futures premiums of spot over the futures price. And really what it is you have markets telling you that they're expecting higher silver prices to come. If you look at the longest dated futures contracts, we're looking at a $5.50 premium over spot. That's the highest it's ever been, even since when silver was $50. Again, the market's signaling that they're expecting higher prices in silver to come. These are the numbers from the Silver Institute. So they put out their World Silver Survey every April, and these are revisions that they put out in November when they update their numbers. So what's interesting is that if you look at the number here, 182. So that's just a regular deficit between what the supply is and what consumption is. That number was actually about 215 million ounces until they revised it in November to 182. So that went down. So they were saying there's going to be a deficit, but not as much as we expected originally. However, if you include what's going into ETFs, that number was 50 million ounces back in April. Now it's 100 million ounces. So the overall deficit, if you include what flows into ETFs, is going to be 280 million ounces, which is almost the all-time high deficit that we saw back in 2020. So the 2024, we haven't seen the final numbers, but it's looking like it's going to be very tight. And a lot of that money is actually flowing into silver ETFs. And we're seeing that happen. So here you have SLV, the largest silver ETF. Since July or so, we've started to see silver ounces held by SLV. They've started to flow back higher. That hadn't been the case for a couple of years. I think that the big industrial consumers were tapping into those ETFs to get physical metal. That started to reverse as well. And this sort of a little sort of side note geopolitical thing, it speaks to the changes that are happening. Russia's central bank has for the first time said now they're going to start adding silver to their reserves, diversifying from gold, platinum, and palladium. And back in December, or end of November, they said that they were going to temporarily ban the export of waste and scrap precious metals from December all the way through to May. So they really want to keep their silver at home. This is going to have, it might be a small impact, but it piles up on top of everything else in terms of availability of silver. So are we approaching a squeeze? Time will tell. But if you look back and you adjust for inflation, that spike in 1980 at government CPI numbers would put you at $145 today. It just speaks to the potential for where silver could possibly go. If you look at the silver price, once the Fed starts to cut rates, within 24 months, on average, in the last 3 rate cutting cycles, silver has spiked has risen 32%. If you look at from the bottom or the middle of a rate cutting cycle, over the last 3 rate cutting cycles, silver has actually averaged 332% gains over the last 3 rate cutting cycles. So, if you want to better understand the opportunity in silver, I encourage you to read my book. That's what the idea was behind it. You can follow me through my newsletter, Silver Stock Investor. It's the only silver-focused investment newsletter. I actually recently launched a new newsletter, a free one called Silver Advisor, and that will follow news from the companies that are under coverage. If you want to subscribe to that, again, it's free. Go to thegoldadvisor.com/registration, sign up there. And if you want to follow me, as I say, go to my website. You can follow me on Twitter, you can follow me on LinkedIn, and just to kind of summarize last couple of notes, this is a candle chart of the silver price. So each of these lines is the yearly price of silver, what it did in that year. This is considered by some technical analysts as the biggest technical breakout of any asset ever. So this is a 50-year cup and handle formation. And potentially once it breaks through 50 and breaks that previous high, we're in uncharted territory. Where it could go from there, anybody's guess. But if you're here, you obviously understand, especially after listening to Rick and Brian London earlier. If you're going to participate in this, do some research, take your time, understand the opportunity, but this is key. If you're going to participate, if you're going to benefit from this, patience really is what I call the rarest commodity. So that's it.